Hi, hello everyone. Welcome to live session for our course on corporate finance. And today, we will be covering the topics from week 5 and 6, as far as we can cover in this 1 hour session, and rest we will cover in the next week. Okay. So a quick recap, till week 4, we have not introduced any form of uncertainty into our economic environment. So starting from week 5, we will delve into like the, we will take one more step towards reality, and like we introduce the uncertainty. And what do we mean by uncertainty? That means, like as you know, future is uncertain. We are not sure what will be my returns in the upcoming times, etc. But in the previous weeks, we consider, yes, we know for sure, this will be the return in the coming period, etc., etc. Although we don't know the future for sure, but we have some expectation, we expect to get some, the 10% return. I expect 10% return to get, etc., etc. And how do we get these expectations? Like, we have some intuition about the probable states in the future, and in these different states, we may have different type of returns. Like, if state, let's suppose there are two possible states, one is good state, one is bad state, and if the good state persists, then I get a higher return. If bad state persists, then I get a low return. So for example, if you are a farmer and you get a good, if the rainfall is good and all the weather is also good, then you get a good harvest and your returns are better. On the other hand, if rainfall is lower and you do not get good harvest, then your return is lower. So this, in these forms, uncertainty comes into the picture. And we started off the discussion with the notion of expected value, or which we also say the average value, which is simply, if we know the probability of probable states, then we can simply sum the probability weighted average of all my outcomes. Let's suppose there are n possible states, then if I take the probability weighted average of the outcomes of these n states, then this gives me the expected value of the upcoming future. Okay. And similarly, there is a measure of variability which we call the standard deviation. So which measures how, by what amount my future outcome may vary. Correct. So its measure is, I think, xi minus x bar square. So, pardon me if I do some silly mistake. Sorry. I think this is the correct formula for the standard deviation. Correct. And also we there was a discussion about fair bet, which means the cost of this bet or this gamble is same as the expected value of this bet. Then if the expected value is same as the cost, then we call the particular gamble as a fair bet. Okay, you can just, those are simple statistical formulas. You can, if you have some basic knowledge of statistics, then those are pretty basic for you to understand this concept. And if you need any further clarification, please do let me know on these topics. Okay. So going forward, we started our discussion regarding the discussion of credit risk or the default risk, which we say. So in the previous case, the previous weeks, there was no notion of default. But what is default? Default means, like you are supposed to get some return, but due to some reason you did not get the expected return which you were supposed to get, correct? That we say is a default. Okay. So, and due to this default, there is a risk which comes into the picture, and which is a part of credit risk, which we say. Okay. And due to this default risk, like the interest rate which is for a particular case flow which is there, like for any loan, if there is some default risk, then the interest rate which you will be paying will be higher. Why? Because of this risk of default. So the total interest rate will have two components. One is the time premium and other is a default premium. Time premium is the if you are if you are lending the money, then time premium is the return which you get due to the delay in the payment, because you are foregoing your money today and you receiving your money later in future. And because of this notion, you get an extra return which we call the time premium. And other component is the default premium, which is the extra return because of the risk of the default. Okay. And the other term which is used for this is the credit premium. So let's understand this concept of default through an example. Suppose I have 10,000 rupees with me, like I have this 10,000 rupees extra for apart from my day-to-day needs. So I intend to invest in some form, and I have two available options. So first one is like a safe investment into the government bonds, and the returns which the safe investment is giving me is 20%. This is a hypothetical situation. So I can invest in government bonds and receive 20% return. And second option I have is I can lend it to my friend Gaurav. Okay, but there is a risk involved with my friend. What is the risk? Because I know my friend Gaurav for a long time, and so I believe that like the in 80% of the chance, there is 80% chance that Gaurav will pay me back with some interest which I ask him, and there is 10% chance that Gaurav will only be able to pay me only the half the amount which I am loaning him. So only 5,000 rupees I will be getting back with 10% in 10% of the cases, and the remaining 10% chances are such that like I will not get my money back. So there is some risk involved that I may lose my money. Okay, so either I may lose half of my money, and I may either lose whole of my money. Okay, so if this is the case, then what is the interest rate that I should charge to borrow? This is the problem I want to solve. Okay, here you see like there is a chance of default, so I need to adjust this interest rate which I am asking from Gaurav, so that my payoff from these two investment options is the same. I use this concept. So the payoff which I get from my investment in government bond is the 1,000 times 1 plus 20%. So this is my this is my return from investment in government bonds. And if I lend to Gaurav, and suppose I ask for x percent of interest rate from Gaurav, so as I said, like there is 80 in 80% with 80% chances he will pay me back. So with 80% chances, 80% chances I will get 10,000 times 1 plus x percent, the interest which I am charging on Gaurav. With 10% chances I get half my money back, and with 10% chances I get zero. So I just simply solve this equation and I get x to be like the interest rate which I will be charging will is 43.75% doing these calculations. Okay, so as we discussed earlier, so this 43% is like there are two components One is the risk-free interest rate, that is the 20% from the given conditions, like the government bonds are giving me 20%. So this 20% is the return which I am getting because of delay in the payment. So we call that time premium. And the excess to that which is the 23.75%, that is the interest rate which I am charging because there is a probability of default associated with my friend Gaurav. That's why I'm charging him higher. So this we call the default premium or the excess interest rate due to the default risk. Okay. So you see, like earlier we discussed about some like the credit rating agencies. So you can relate this default concept to these, like the credit rating agency, like if the ratings are lower, then there is a higher chances of default. And if you see the return or the interest that those bonds with lower rates offer is most is higher than the bonds which are rated higher or which are rated risk free. So for example, the bond which is rated as triple A rated bond will have interest rate lower than bond which is rated triple B. So you can go to, like you can search on Google or you can go to any website which offers the yields for the bonds, and you can compare the you can compare their credit ratings and the yields they are offering. So you can take these, like the what is the relation between the risk of default and the interest rate they are offering. Okay. Now this is the one of the very simplest case in which like the uncertainty may arise. So this uncertainty may arise in the capital budgeting, which we which we learned in week 3, like different rules of capital budgeting. So how do we represent the uncertainty in this capital budgeting? For that we use a concept called as payoff table. So what is payoff table? We like the note down different outcomes under different states or the different possible scenarios in a tabular form. So for example, this table shows like there are two possible states. One is bad state, one is good state, and probability of this state occurring is like the 25% chances for the bad state and 75% probability for the good state. And this is the state in the coming period. Okay. And if the bad state occurs, then in the coming period the value or the payoff you will be getting is 50. And if good state occurs, then the payoff you will be getting is 150. Okay. And it is given like whenever there is uncertainty involved, we talk in terms like this rate of return is given as the expected rate of return. Okay, so the expected rate of return in one period is 25%. If this situation is giving, then first thing what you do, like you first compute the expected value in the coming period. Like there are two possible states, and you can simply compute the expected value by taking the probability weighted average. So the 25 0.25 is the probability times the payoff is 50, and 0.75 is the probability of the good state, and 150 is the payoff. And through this the expected value after one period is 125, and we can use this expected value and the expected rate of return to get our present value. And we use the same formula, like this is the value and this is the interest rate, and through that we get the present value to be, and we find that present value is 100 given this payoff table. And as we know, like if this is a fair bet, then the present value should be like the cost which this payoff or like which this cash flow should have. So let's suppose 100 is the cost of this project, which is supposed to have this type of payoffs. Then if we consider that, then we can compute the rate of return is in these two different states which are given to us. So we can compute the rate of return in bad state and good state, and we find that in the bad state return is negative 50%, and in the good state the rate of return is positive or the plus 50%. And we can again we can use the like the expected value formula, and we find that the expected rate of return is 25%, and which we used to get these values earlier. So these should match. Correct. And like the I think in GA there are one or two questions which use this payoff table and ask you to compute like the expected value as well as the rate of return in different states. And so those questions will give you a good hands-on exercise on this topic. And if you have any other concerns, please like that to let me know about that. Okay, so this is about like how we can get like the present values if there is uncertainty involved, and how we can calculate the rate of return in different possible states. Okay, now we move further, and the next discussion was about the financing of the project. Okay, so earlier we did not discuss anything about the financing of the project, but there are two main tools for the financing. One is debt and other is equity. Debt is like you take the loan for a project, and that we call the debt. And equity is like you offer ownership on the given project. Let's suppose you are building a new shopping mall, and you take some loan from the bank, that is part of debt, and you offer equity, like you offer ownership in exchange for some money upfront, and we call that equity. So equity, so in terms of any firms like the listed firms which we say, like which are traded on the stock market, so those firms take loans from the banks, those are part of their debt. And these firms also offer shares in the stock market, and then those are part of their equity. And the basic rule is like the whenever there is, so basic rule is first firms are supposed to pay the debt, and then the remaining amount is distributed among the equity holders. This is the basic rule of financing, like the. So let's understand like how this debt and equity financing works. So in the lectures also, professor used a simple example, and we will also try to do the same here also. So suppose like in the previous example, we find out like the 100 was the present value or the cost of this project. So we need 100 units, or let's suppose these units may be lakh rupees or crore rupees, etc. So out of those 100, 75 is financed with debt and 25 is financed with equity. Okay. Now the question asks like what is the promised rate of return to the creditor? Creditor means the person who is loaning you the money, or the from whom you are taking this debt or taking this loan. So given the situation, what is the interest rate that will be charged to you, or the what interest rate you should promise to this creditor? Okay. So here like the we already knew like there were two situations, two possible states. One is bad state and good state. In bad state the final value was 50, and in good state the final value was 150. So if bad state occurs, then so there is only 50 value available to you. So all of these will go to the creditor who has financed you 75, and the assumption which we have taken here is that like this is a non-recourse loan. That means you cannot take anything else apart from this project from the person who is building this project. Okay. So if bad state occurs, then creditor gets like the 50 units, and if the good state occurs, then we need to find out like how much should this creditor get. So we assume that to be X, and we use like we know like the expected rate of return was 25%, so we use that to get this unknown value X. And for that, what we do, like it is same like if you like the present value of the debt is 75, and this should be same as the expected return which you get, and we discount that with the expected rate of return. Or in either words, we can say like the 75 times 1 plus expected rate of return, this should be same as the expected payoff of this creditor. That is, bad state he gets 50 units, plus in good state he gets X units. So we need to solve this equation for this unknown value X, and we get X to be like 108.33. So this is the this is the this amount you should promise to the creditor, that like if my project succeeds, like in the good, it happens to be the good state in the future, then I will pay you back 108.33 units. Okay, so if this is the promised amount, then the promised rate of return you can simply compute, and that comes out to be 44.44%. And we do a check again here, like the expected rate of return should come out to be 25% here also. So this check is correct. So in the bad state, what is your rate of return? Can you give like the compute this? Like you invested 70, like the person who is the creditor, he invested 75 and got back 50. So I think his rate of return is minus 33%, and in this he gets 44.44%, and the expected rate of return is 25%. And here in all this situation, we are assuming a risk neutral environment. Okay, so and details of that is given by the professor, like what we mean by this. So this is the situation which the creditor is facing. Like if good state occurs, then his rate of return is negative 33.33%, and if good state occurs in the future, then he gets 44.44% in return. That is the case. Now what happens to the equity holder, person who takes who invest in the form of equity? Okay, so the total investment was 25 units in form of equity. So if bad state occurs, then the total payoff, which was 50, that goes to the creditor. Nothing is left for the equity holder. Okay, and if the good one second okay, if the good state occurs, then he gets the remaining amount. So the remaining amount is like the creditor gets 108.33, so the remaining amount is 41.67 units. This is the payoff which the equity holder gets. So we can again compute the expected rate of return. So if bad state occurs, his payoff is negative 100%, and if good state occurs, his payoff is 66.67%. So in this way, like what we have done by using this debt and equity financing, Like there was a project which involved some uncertainty, and uncertainty brings risk into the environment. So there was a project which had some good and bad state. Like let's suppose this is bad state, this is good state. And like in the first case, like what was in bad state, you got minus 50% and plus 50%. So you got minus 50% and plus 50%. Okay. Now what happens to the if you invest in the form of debt? So how, if you invest in the form of debt, then your in the bad state you get minus 33.33%, and in good state you get 44.44%. So in good state you get this, and in bad state you get minus 33.33%. And what happens to the equity holder? In bad state, his rate of return is minus 100%, and in good state his rate of return is 66.67%. So this black one is equity, this blue one is your debt, and this red one is your original project. So through this equity and debt financing, we decompose this original project into one more risky and one less risky project. Okay, so this is how we can like evaluate the debt and equity financing. Correct. So why we say more or less risky? Because of the way, like the variability these returns have. Because in the debt, the band of returns which you get is like narrower in comparison to the band of returns which you get in the form of equity. Like you can either get minus 100% or you can get plus 66.67% in the equity, and in the case of debt you get minus 33% against plus 44%. So this bandwidth is narrower in debt and bandwidth is wider in the case of equity. Okay. Next, there was a discussion about the balance sheets. So I will just touch a few aspects like what we mean by the balance sheet. Balance sheet, like if we take the example of a bank, then balance sheet is the way to tabulate like the assets of this particular firm or the bank and liabilities in it, like in a format, like in one side all the assets, in other side all the liabilities. And from this balance sheets, two, like the two, or we may say like one key ratio which emerges, which was discussed. Like there are many other ratios or many other aspects which are there in the balance sheet, but we touched upon one only, which we call the leverage ratio. Leverage ratio is the ratio of assets to the capital. So what is capital? Capital is the what is invested by like the its owners. What is what has owners have invested in this particular firm? We call that capital. And assets is what that particular company owns, and liabilities what that company owe to others. So these liabilities includes debt or the equity. All these are part of liabilities. Assets are like all the machinery, not the machinery, like what I can say. Like so, if we consider a bank, then assets will include all the bank's investments and all all the loans which the bank has issued. All these are part of bank assets. And in the case of liabilities, like the deposits which the depositors has given and all other borrowings which the bank has taken from, like the in the case of India, it may be RBI or other, like from other banks, etc. all the borrowings and the deposits will be part of the liabilities. Correct? And why this leverage ratio is important? Then because we can link it to the like its riskiness and profitability. So higher leverage ratio means there is higher expected profit per unit of capital, and as well as this also indicate like there is higher risk of bankruptcy, like there is higher chances that your assets will fall short of your liabilities. So that is why it is very important to keep track of leverage ratio, particularly in the case of banks. So these were the key some topics which were covered in week 5, and then we started the discussion about like how individuals make choice, and which was like some part of that was covered in week 5 and some of that was covered in week 6. So I will now move on to that. So please let me know if you have any concerns or doubts in any of the topics which we have covered so far. Okay, great. So let's discuss like how individuals make choices. Okay. So while making the choice, there are three key components which individuals like take into account. One is the budget set. What we mean by the budget set, like the for an individual, let's suppose I have some income. So given my income, let's suppose I earn 10,000 rupees in a period. So given this income, I have a certain set of bundles or the combination of goods which I can get. Let's suppose if I purchase some books, then only the remaining amount I can. So let's suppose I like use my money for two things. One is books and one is for my food. So if I like the use 4,000 rupees for my books, then only 6,000 is remaining for my food in that case. So given my income, what are the possible combination of the goods which are available to me? That is my budget set. Second is the preferences, like what do I like? I like food more or I like books more. What is my preferences? If these two things are known to me, then my objective is to choose the one which I like the most from the available bundles, like the available combination. I will choose the one which gives me the most value or the most utility, which I say. Okay. So we how let's understand this in the form of like graphs or plots. So let's suppose there are only two goods. So why we say only two goods? Because it is easier to draw graphs etc. in 2D, and we can also use these two goods case, like we use one good is the thing which I want to model. Let's suppose if I want to model my food, and then I will put my first good to be food and second good to be all other goods which I all other things which I want to consume. Okay, then it will give me my utility functions in terms of food and all other goods considered as like as a composite good which we call the x2. Okay, so let's suppose my income is m, and there are two goods, like one is food and second is all other things, and the price of food is p1 and all other goods their composite price, as we discussed, like I can use a price index. I can create a price index for all other things I want to consume, and we call this that price index to be p2. So okay, if this situation is given, then in an x1 x2 in an x1 x2 lane, I can represent my budget set, my preferences, and if I get these two, then I can combine them and then I can get my final optimal point. So how do I represent my budget set? So let's suppose my income is M. So maximum I can, so let's suppose I just want to consume good one, that is X1. So use all my income on good one. Then, so what is the amount of good one I can consume? That will be my income M divided by its price, that is P1. So this M by P1 is the maximum I can consume of good one. Similarly, M by P2 is the maximum I can consume of good 2. And if you see, like, all these points which are on this line is represent this equation equal to M. This black line represent this this equation, and my budget set will be like my, like, the cost of these goods should be less than this. So less, if I use this inequality, that means all the area which is like earlier it was lined by blue color, and all the shaded area, this represent my budget set. Budget set means like I can consume the any of the point, like any of the point, or any point represents a possible bundle or possible combination of x1 and x2. So these all points are available to me. I can pick any one of them. So now my my objective is to, like, the pick the one which give me the most utility. Okay, and utility comes from preferences. And how can we represent utility in x1 x2 plane? For that we use indifference curves. An indifference curve is the curve which, like, represent the combination of x1 x2 which gives you same level of utility. So for example, this this black colored plot is a indifference curve. That means at any point, like at this point, at this point, like these points or these combinations gives you the same level of utility. Let's suppose u bar. Okay, and age, like, if these two x1 and x2 are goods, that means both of them gives you positive utility, increase your utility. Then further you move away from the origin. So if you move in this direction, then it means like your utility is increasing, and if you move closer to the origin, that means your utility is decreasing. So given this condition, now we can combine both of these, like my budget set and my preferences, and both of them are in x1 x2 plane. So if I combine them, and so my objective is like use one use a point from this given feasible set or the budget set, and use the which gives me the most utility. That means the farthest, like the indifference curve that is farthest away from the origin. Okay, for that, like, if I combine all these, so my optimal point will be the one, like this red colored point, which means like my optimal point will be the one where my indifference curve is tangent to this my budget line. Budget line means this black colored line, which represent like when I exhaust all of my income. So if when this situation occurs, that gives me the, like, this is my optimal consumption point. So let's understand this situation with an example of what we say, like, with some numbers. Let's suppose, like, the income in this case is, like, if my income is 100 and there are two goods x1 and x2, utility function is given as square root x1 plus square root x2, and the prices for good 1 is 2 and price for good 2 is 4. If this is the case, then how we proceed? Look, first I want to get the budget set, correct? So what will be my budget set? That is p1 x1 plus p2 x2 less than m. That means 2x1 plus 4x2 less than equal to 100. So I can plot this in x1 x2 plane. So what will be my x1 intercept? That will be 100 by 2, that will be 50. My y intercept will be 25, and so this is my budget set. Okay, next I am given, I have been given this square root x1 square root x2, that like that is like more or less this form of indifference curve only. And mathematically, how do we solve this? So mathematically, my optimal point is the one where like slope of my indifference curve, that slope of my indifference curve is MRS, marginal rate of substitution. So what is like is MRS? That is like don't like bother by don't get bothered by this like mathematics, like it is, if you don't fully understand, like it is just meant to like get to the point where we use this utility for our assets case, like where how do we represent, what do we mean by utility functions, and how we can, why this is important, how we get this optimality condition. We need to get the idea behind it because it will be used later for our portfolio theory, like how we get to the optimal portfolio, correct? That's why we need to understand a bit of this. So this is the slope of my indifference curve. Okay, so given this, my u is square root x1 plus square root x2. So I can, this is the partial differentiation, so that will be minus of divided by minus of 1 by 2 root x2. So that turns out to be minus of square root x2 upon square root of x1. And at optimal condition, at optimal condition or optimal point, this MRS should be equal to slope of budget line. And slope of budget line is minus P1 by P2. So this should be like the minus of root x1 upon root x2 should be equal to minus of 2 by 4, and we can solve and we get like x1 is 4 times x2, and we replace these values in our budget constraint or the budget line. That was like 2x1 plus 4x2 barabar equal to 100. If we put this value in this, and from that like we can get x1 to be 100 by 3 and x2 to be 50 by 6. So this combination is the is optimal point for me. Okay, so if we want to view this graphically, so we got x1 x2 and this was the point, and so optimal point will be the one where this indifference curve is tangent to this, and this point is like 100 by 3, and this is 50 by 6. This was 25, this was 50. Okay, this is how, like, this is what we mean by the optimal, like, optimality point. Okay, any doubts or any other explanations if you need, please do let me know here. You will see in the coming weeks like why this was discussed and why it is important to know. Now this was the, like, the deriving the optimal points in the case of certainty, like when we know all the things, but how we deal with uncertainty. Okay, so how do we make our choice under uncertainty? So for that, again, like, we take the simplest case where only two possible states are possible. Let's suppose there are two possible states, one is good and one is bad, and bad states happen with 20% probability, good state happens with 80% probability. In bad state, your payoff is 25 units, and in good state, your payoff is 100 units. Okay, so this good and bad condition may be like good harvest, bad harvest. Bad condition may be like you get into an accident, and good state is there is no accident, etc., etc. So if this, like, there is a possibility of bad state happening, then how we can, like, deal with this? Like, we can go to the market and buy an insurance, like, to get some recovery in the case of bad state occurs. And we can use this concept of insurance to get our state contingent budget constraint. So how do we do that? Like, let's suppose, like, you, for this bad state, you buy an insurance of X units, and you pay a premium of 0.2 times X. Like, that means like 20% of the insured amount is the premium which you pay. Okay, so if this is the case, then I can use this insurance amount, like, if I buy this insurance, so in the bad state my payoff will be 25, and this bad state is occurred, so I will get this payoff, like, this insured amount, that is X. So 25 plus X minus the premium, that is like the 0.2 times X. And if the good state occurs, then you will not get the insured amount, so your payoff will be the 100 minus the premium which you paid. And now, how do you get the state contingent budget constraint? For that, like, from these two equations, your objective is to eliminate X, and if you do that, then you get a equation in terms of CB and CG, which we call the state contingent budget constraint. And then, like, we can use this budget constraint, and we can use the expected utility because there is uncertainty. So we use the expected utility, like, we use this as our, this is my utility function, this is my budget line. If these two are given to me, then I can use my optimality condition and solve for my optimality point, and that is what we do in our cases. And from that, like, we can get, like, what is my optimal CB and CG. So from that, like, if we do that, from here we get, like, the optimal point is the one where, like, in both states, both in good and bad state, your payoff is same, and that is equal to 85. That is your optimal point. Okay, so this is the case where, like, the premium which you pay is the 20% of the insured amount. If this premium is different, then your optimal point may differ. this depend on a lot of things. Okay, this is how we incorporate like the uncertainty in our like the uncertainty into our environment, like to in making our choices, etc. So first we discussed about making a choice when like in the current period, given like when everything is known to you. Next we move to the uncertain condition, like when there are two possible states, good and bad, and for that like we use the state contingent, budget constraint, and expected utility, and got the condition like what should be my consumption in good and bad states. And so I would ask you to like use some different insurance conditions, like the premium to be 10% of your insured amount, then what will be your optimal like the good and bad state consumption. Okay, and later on like there was a discussion about the certainty equivalent. So certainty equivalent, the amount of the money or the payoff which is given with certainty, such that the individual is as well off as the lottery. That means like the uncertain conditions, like lottery means a gamble, like there are multiple outcomes possible. So if we take the example which we used here, so there were 20% chances that your payoff is 25 and 80% chances that your payoff is 100. So your expected utility, if your utility function is square root of c, then your expected utility is c. So like that is 9. So your certainty equivalent in this case turns out to be 81. That means if 81 units is given to you for like with certainty, then you are as well of as this given gamble. That means like with 20% chances you get 25, and with 80% chances you get 100. This is not very like the when we study the insurance or the actuarial markets, then like these types of topics are discussed into detail. Okay, any doubts or anything you want me to repeat? Or so okay, so these were the topics which I wanted to cover. And from in the next live session, like I would move on to like the risk and return, how like this like the utility function or the indifference curves are moved when we talk about the assets. So for assets, like we need to draw our utility functions for like the in the plane of like mu and sigma. Mu means the expected return, and this is the sigma is the risk or the standard deviation of my returns. So in mu and sigma plane, how what will be the shape of my indifference curves, and how we can relate it to like the making our choices about the various assets, like which one to choose and which one not to choose. Okay, great. So we will cover these things in the next live session now.
Thank you.
Yeah.
Thank you, sir.
Okay. See you next week now.